Maren, not wanting to kick off this episode in aggressive and rude fashion, but what's that cartoon character with the flame hair?
Oh, Jimmy Neutron?
Yeah. I try to push this down, and it just, look.
It just keeps coming. It just springs back into place. Jimmy
It's
Neutron.
The Greys have a life of their own.
They
Just do whatever
They're-
they want.
Jack, you wouldn't know this because you don't have any hair, but I must admit, the more grey I go, the more they're like wires.
Yeah, but you've kind of got that. What was the Nanny Fine? What was that show with the
Oh, the nanny. Oh, yeah.
the guy?
Yes, Niles. Niles the butler. Yes.
Anyway,
I was out on the boat the other week and was trying to take a selfie, but just the way the light was reflecting off the water, I looked so grey and old. I was like, no, I'm just going to pretend that I'm actually young.
Just wear a hat. That's what I do. Makes you look younger. Hat and big sunnies.
It makes you look something. Well, we're waiting for Ash. Jack, you got daddy daycare today.
I do, yeah. Both the grandmas weren't available to look after Louis, so I got the call up.
Oh, that's good.
Subbed off the bench.
Yeah.
It's good to see you
Tell you what,
multitasking.
it's much easier going to work, isn't it?
Oh, yeah, kids.
Anytime I hear someone say, "Oh, my wife doesn't work," it's like, you fucking moron. That is absolute bullshit. That is 1,000 times harder than going into the office and pretending that you're something that you're not.
Yeah, I totally agree.
Yeah.
Hi, sorry.
Here's Ash.
Hey, Ash.
Ash, your grey hairs, are they thicker than
I don't
your normal?
have grey hair, thank you.
Oh, okay. It's just
Even
Maybe
my
just-
hairdresser said I still don't have grey hair, so.
we were just talking
Well
about
done.
them before you arrived.
Not
Not
talking
the
about
great
yours,
hair,
talking
no
about
hair.
ours.
Yeah, true. That's true. So what's been happening? Got a big episode of stuff. Before we jump into that, what's going on?
Well, I missed last week's episode, and I haven't gone back to listen to it, so I don't know if I want to.
It was a little rambly on my behalf.
Well, I got to listen.
I thought it was quite good and succinct.
Okay.
My absence tends to do that, so. But no, for me, it's been a bit of focus on family. So my niece came out of her surgery, and the house was full of people, and Maren and I ducked off for a quick few nights away and had a bit of time to ourselves, which was awesome. But everything's going well. Kids are back at school, so it's nice to be back and just able to focus.
Focus. I like that word. I lecture a lot of people on it, but it is evading me at the moment. Although I'm very excited, the Mackenzie household now has more than one toilet. So it's the little wins in life.
Which Don did share with us by sending a video earlier this morning of him drinking a glass of water from the toilet.
Foul. Absolutely foul.
Well, we're still trying to work out if it's appropriate LinkedIn content or not. Jack, I've got a vote from Jack that it is, given the Broncos won and the controversy that Payne has caused by doing it. Ash is saying that it's not.
I reckon go for it.
Cannot. Oh,
The thing is, it's a brand new toilet, and I know that it's clean, but my brain...
You don't. But you don't know where that toilet has been. You are trusting a third-party tradesman to have kept it clean.
No. I bought it from the manufacturer. I carried it into my trailer. It's been in a box
was the trailer-
unopened. It was in a box unopened, and then it was carried into my toilet.
You mean your bathroom?
It was, look, Ash, it was treated with all sorts of pesticides to make sure nothing came into the country from where it was manufactured. So,
Yeah, and Don's now just...
But the question, is all social media, is it good for the brand or is it not? It won't be surprising.
You know where I stand on this? I just would not like to be tagged. Thank you.
Oh, well, now you're going to be the only one tagged now, so...
that is it.
I can mute Don being able to tag me. Let me just update LinkedIn.
That is a smart strategy just in general.
Well, we've got a big agenda because there's some items that we carried over from last week. I thought we would start with, there was an article that came out in Capital Brief this week, which was a follow-on from another article that was focused on women in VC leaving to go into operator roles. I think broadly, there's a lot of people leaving VC to go into lots of different roles, and it's a really tough gig at the moment. There was a chart, I don't think I've got it in this week's charts, but the number of VCs just open and alive globally has shrunk fast. But this article says, meet the trailblazers. As women leave VC due to limited pathways, Maxine Minter of Co-Ventures says there's another route forward for those who want to stay. Build your own fund. And I really like that. It's sort of, if you want to do something, go and do it. Pull your socks up and go and start your own fund. And so the article goes on, when Maxine Minter launched Co-Ventures as Australia's first solo female GP fund, she expected others to follow. After all, only 5 funds in the country regularly deploy capital at the pre-seed and seed stages, and around 40% of early stage market is funded by international investors. Co-Ventures remains the only specialist pre-seed fund, what Minter calls a deeply uncompetitive market. The article goes on, it talks about Kylie Fraser, who co-founded Flying Fox Ventures with Rachel Newman, who said that whilst enthusiasm to start funds exists, along with the market opportunity, the reality is that many women are limited by wealth, which gets them through the door in the first place. Let's come back to that and unpack it. One of the things that really struck me when fundraising was the question from LPs around GP commit, Fraser said. When LPs ask how much are you investing, this is an additional barrier for emerging female fund managers. I think we'll come back to that. Sarah Nolet, who was a co-founder of Tenacious Ventures with Matthew Pryor, thinks networks are the real obstacle to starting funds. An American who moved to Australia without local networks, Nolet described herself as an outlier who spent 5 years running consulting businesses to build the network and credibility needed before she could raise that fund. There's a range of other things in this article. Both of Sarah and Maxine talk about, after raising funds, the challenge is staying afloat on marginal fees. But Minter argues that venture isn't unique in this respect, given many businesses aren't profitable for the first few years. You need to think about how you're going to get the venture to the first 2 funds, because you only generally start to break even at fund 3. Yeah, the article goes through and talks about a range of things. I think absolutely it's worthwhile putting a spotlight on women in VC. I think it's also reasonable to just look at VC itself, and I like the starting point. If you want to do something, go and do it. Anyway, what do we think?
Yeah, Maxine's a legend. So well done taking this on as a solo manager. Like, I think about that. How on earth do you make that work? And credit to her for making it work. I think of all the multitude of things that we have to do as a fund manager and the workload, and I feel like there's just never enough hours in the day. So I definitely, full credit. If she's making that work, well done. I think the thing about people leaving VC, I mean, there was just another fund last week. It feels like every week there's a new fund we've learned is winding up. And I got GBT to do some deep research on the stats. And over the last 20 years, 27% of all first-time fund managers didn't successfully raise a follow-on fund. But when you actually look at by sizes, when you're talking the smaller fund sizes, it's actually closer to 35% of sub-10 mil funds don't go on to raise a subsequent fund. And that's over the last 20 years. But
those stats seem pretty good. I'm surprised by that. I would have thought it's worse.
Yeah, but more recently, it's over 40%. So 40% of first-time fund managers in the kind of post or during that last cycle haven't got on to raise a subsequent fund. And what was the stat out of the US? We saw the total number of VC firms in the US is down 25% in the last 12 months. And so there is a huge contraction, and that's not just funds disappearing, but roles within funds, headcount dropping. So I think what's been described here is across the board. But I think this thing about, there is this value of death in VC to get to fund 3 before you have enough revenue in fees to cover your OPEX. And unless you have a differentiated business model with other revenue streams, which we've architected, but that means there's a 7 to 10 year valley of death that you have to traverse as a fund manager. Some of them approach that from the point of view of they've made their wealth elsewhere, which this article touches on. but it is a bloody huge gap. That is a huge hurdle to jump over. And the interesting part of that is, Don, we came into this with previous experience in business, previous angel investing experience. You have quite extensive angel investing experience through Brisbane Angels. But as soon as you are managing someone else's money, that scoreboard resets. Like, yes, there's good experience base there, but what an LP is looking at do you have experience managing someone else's capital?
Yeah, and that's why I like Sarah's approach more in the combo. It's really networks. Having a level of wealth absolutely helps, but we know a lot of people that have had quite a bit of wealth try and get in this game, but then they didn't have the networks to sustain. And then people without the wealth but had the networks have been the ones that succeeded. And like most things, money can make some things easier, but it isn't the ticket to the ball game. So I get a little bit intrigued at the arguments to say that if everybody just had more money, but at the same time, there are barriers that we've acknowledged before around women participating in an ecosystem like this. But for those that really want to do it, then as long as we've got equality for access, and for me, the best thing you can do is build out networks. And I don't see an excuse for that. It can be hard, and people don't want to put in the 5 years that Sarah did. For us, we decided to start syndicating. We've taken 4 years to sort of do that. It was the longer route, and it's harder, and you've got to make sacrifices. But yeah, I think people have to look at it and say, well, you may want to achieve the outcome straight away, but actually the world doesn't work like that. What are the sequence of steps that you've got to put in front of yourself to earn the right to get to that position? And I think people like Maxine and Sarah and others demonstrate that it can be done.
Aaron touched on most of the points I was going to call out. I think the network piece is big, and I think particularly in the Australian context in particular, where sales cycle is much more relationship driven, this has an even bigger amplification. I think I've felt that where I didn't anticipate the sales cycle from first call to being able to have a true sales conversation to be this long here. It's definitely opened my eyes to that. And I think the network of being in and around the ecosystem for 5 years to then be able to pour in, that makes a lot of difference. I do think that having a business that enables you to build that network across Australia and New Zealand, Asia would be really the big difference, where I find that the states are quite isolated here in terms of network. So I think that also has something to do with it. Our business is based into non-dominant states for startups and VC. So I think that's another element to add into how we have to deal with some of these challenges. And I think, Don, it is not just a female barrier. I think it's amplified by there was a point in the article about having to prove your ability in every meeting versus investors assuming that you are of value when you walk in and then just closing it. I think that's something that any female in business, I'm sure, can resonate with, not just in VC. So I think there's a lot of macro elements to this that are, I think, just amplified with this industry.
When I read the article, one of the things that stood out is something that we've discussed before, is part of what I think we're really talking about as well, is what size VC can provide the best returns. And Maxine being a seed, small solo GP, along with Flying Fox and Tenacious, is time and time again, the data shows that the smaller funds, when picked right, provide better returns. And that's just the law of the large numbers thing. As the fund gets bigger, it has to write bigger and bigger checks into larger and larger things and they just don't get time to look at smaller deals, nor does their deal flow get set up for that. And James Sedgwick on LinkedIn posted the top decile of over 30% performance by fund size lives with the $0 to $250 million mark. And I think actually we've seen other data sets that's actually sort of the sub 100 and then it drops down to the 250 to 500, then 500 to a billion, and then a billion and above. And so this is data from PitchBook as of Q2 2025. And he also makes the point that, yes, survivorship bias exists in VC. The lack of complete data set fundamentally affects the performance data of every fund size. However, survivorship bias does not affect best performers. There's a linear correlation between fund performance and fund size. Yes, managers are the needles in the haystack. Yes, there's lots of them. Yes, there's strong arguments why we need more firms out there, but finding and backing the right ones. I think for people looking to back that smaller manager, I think it's important that you just understand the core parts of the value chain for this. And it comes down to the person you're talking to. Do they have something that's differentiated and going to help them find the best deals? But do they have some tools, some experiences, some frameworks, some approaches that then helps them choose the best deals? Because you can find a lot of stuff, but if it's actually not going to deliver a return, you've got a problem. But actually, as we found, you can't just choose the best deals, you've got to win it. And in a competitive marketplace, why is this small fund or this team of people going to have attributes that founders are going to want to work with them? Like, what is the value add? What's going to deliver? And then half the time, once you get into the deal, what you thought was going to happen doesn't quite work out the way. So does this small fund have the ability to support them, to guide them? Do they have the, again, experiences, support frameworks, tools to help them sort of get to that point of providing a venture return? Because the majority of companies that we see die didn't need to die, but their support processes, the way they went about certain things, they sort of grew broke. They sort of, they drove off the edge of the cliff. They didn't have people around them that could help sort of create a missile into a sort of guided missile. And then exits. Is there some mechanism, either by at least some secondaries along the way, but some proven ability to actually generate exits? And so I think they're the 5 buckets that people really should be evaluating. Tribe Global Ventures. But what did we think about James's post?
Yeah, I mean, we've been talking about this for a long time. We've seen this data in all different forms over the last 4 years, and it's good to see more confirmation of where we play in our thesis, and even our targeted returns being top decile with 30% IRR target on our fund. I totally agree with you there, Don, but it was interesting in the comments that, so for example, one of the comments from Ollie Hopkins was saying that smaller funds don't have the same access to deal flow. Now, I disagree with a generalist statement like that. And to your point before, what we're seeing is commoditization of deal flow, access to deal flow. And so the ability to win the deal at the exclusion of others actually becomes more powerful, and that's where we focus. But then, I think this is where differentiated strategies, in my view, will ultimately win. Like, it's one thing to be a small fund manager, but that's of itself not sufficient to get outsized returns. And so I just found it interesting reading the comments and you can see all the little biases coming in from people's own perspectives. But I do think the landscape is shifting. What would be good to see is, of all funds that started, so that to remove the survivorship bias out of this, of all emerging fund managers that started, what is the return profile?
Yeah, and again, in that first time fund manager, coming back to that last article, what are the signals that give you confidence? And to me, it's portfolio. And what is your existing portfolio, either in a syndicated basis or on individual investments? And as time goes on, that's what's sort of helping us in conversations. Jack?
Yeah, just following on from that current comment, Aaron, I totally agree. I suppose from like an investor's point of view, like when they're looking at a bigger fund, more time in the game, the natural assumption would be just better networks. And this is something we chat quite often internally. Like, we believe 2/3 of the value actually comes from being able to find the deal. But that historically has been the main driver of an outcome. But we see that actually becoming commoditized. And that's something like we've really hammered home and has resonated well with our LPs. It's like we offer the value add of doing the missions, doing the offsites, and how that positions well with the founders. And we've actually found a few of our portcos, and some that we're actually speaking to have sought us out from seeing us, like the stuff we're doing, taking people to the US, UK, and actually coming to us for that reason.
Yeah, exactly. And it's interesting, like the amount our industry focuses on total deal flow, like very top of funnel as a metric, as opposed to, I mean, obviously we have investment outcomes, but if your performance criteria is total deal flow versus relevant deal flow versus the high value that you actually invest in, I think it can lead to some kind of inefficient outcomes. Ash, what's your take on this one?
Look, I think at the end of the day, it's a mixture of everything you've all touched on. I do think it's the quality of connections as well. Yeah, as I was chatting about earlier, it is a relationship game, particularly as an early manager, where I have the best traction with net new investors into Tribe, i.e. not current syndicate investors, where if they have known Aaron and Don throughout the ecosystem, and quite often that's Aaron having done missions in some shape or form over, the past 10 years, that value add to the ecosystem is quite often what opens the door for that broader conversation. So I think it is, to Jack's point, the value add that our business really focuses on is part of what differentiates us. But it's still a relationship driven game, more so here than I've seen in the US market. I think the US more broadly as a investor appetite is a bit more cutthroat, just purely looking at returns and going, are you going to get it? How are you going to get it? Great. Do I know you? Don't care. Can you show me how?
And I agree with you, Ash, but from a differentiated point of view, how many of their other VCs would drink from a toilet? So on that basis,
I'm not sure if that goes into the pro or con column as we previously discussed.
I think we could have a bar chart of funds that have returned capital and funds where the manager has drunk from the toilet. They might be non-concentric.
All right. I don't want to hang our hat up on that. But I think
this place has gotten all very serious all of a sudden.
And drinking your own toilet's pretty low.
Well, the toilets aren't up, shoulder height.
That is such a bad joke.
Oh my Lord.
All right, sorry. Look, yeah.
Time to transition.
I think it's important that people just have a model to evaluate, because choosing a manager is like choosing a venture deal, and the value accrues to a few. But inside the managers, do they have a track record of backing some deals? And one of our portfolio, SwarmFarm, who we work really closely with, Andrew and Jossie Bates, they formally announced their $30 million raise that actually closed, I think, a month or so ago, which is just really exciting for them because they have put a lot of effort in. We tipped in a small amount. Given our size, we can't compete with $30 million checks, but this really will take them to the next level. I've really enjoyed supporting that team over the last little while. They, like a lot of high energy, high entrepreneurial companies, you get to a point where you have just so many different priorities, so many different things, so many different opportunities, and helping bring some rails to run on and some structure of, okay, you're through the product market fit phase now, which a lot of the companies take a while to get through. So your product's good. You've worked out a reasonable go-to-market. Now it's all about operational excellence. There's a certain phase in the life cycle where it's you can reduce the number of fires that you're burning by just saying, okay, we've got our product, we've got our channels, let's get this humming. And that $30 million is really going to help them create a powerhouse, I think, inside there.
Yeah, this was awesome to see, and a fun one for me because I had the mix of previous syndicate investors who saw this deal come initially, and then to be able to pick up the phone and call them and say, hey, the next round's here, here's the uplift, here's what we've seen, here's why we're still convicted. But then at the same time, have to call and give the whole spiel to new investors. Having the conversations with both was really fun, and to be able to have a great narrative to be able to chat to investors about and only reiterate our conviction on why we're backing them again, and the work that both Aaron and Don have done, and Jack in particular, as how it relates to pushing that forward is, it's been great for me in my seat without having done the hard work.
What I love about this one as well, like, it's fair to say SwarmFarm has activated a lot of new investors into ag tech. When I think we kicked off 4 years ago and we took an ag tech deal to the syndicate, there was just such strong feedback of disinterest in anything in ag because of the city perspective, that it's a hard environment, it's super harsh, margins are low, and all the things that we know are absolute pain points. That is all true, but those pain points make it ripe for these types of technologies to be adopted. But I think it's like that visceral component of SwarmFarm and what they're doing. Like it's when you see it, when you witness it, when you even watch a video, if you don't get to see it in real life, it's really tangible. And I think that's attracted a lot of new investors into the space. So I'm hoping, I think the other thing as well is I love that it's actually got a manufacturing component. Like we're building out this onshore manufacturing, and like for me personally, I just love seeing good tech hardware being built locally. So excited to be on the journey with Andrew and Jossie.
The other thing as well, Aaron, like when we first invested was like peak SaaS, and like at the time, no one liked hardware. No one really understood what hardware as a service. And like their model isn't a clean cut hardware as a service, but it's a leasing model. So it's still recurring in nature, but it's just funny. Like that was sort of our first investment into the hardware space. And we've since like seen many other VCs shift from pure software to software and hardware.
Yeah, and it's also got a marketplace component too that they're building out. So it's sort of hardware plus SaaS plus marketplace. And when you get that sort of level of stickiness, and then because if somebody decides to go somewhere else for a while and stay with tradition, they turn over machines so quickly that once you get onto the platform, even if you delay getting onto the platform, you're not shut out forever. And then once you are on the platform, because what their strategy is, rather than trying to be all things to all people, is they partner with the implement providers. A bit like I've got AEG, and now I'm forever buying everything AEG because I'm on that core platform. Once you're on the Swarm platform and you've got lots of these providers, you really sort of get this, this scale. And so that's why we liked it. And you're right, Jack. I remember a couple of the early investor calls, they were questioning our intelligence going into low margin ag that's connected to the weather and droughts, and it's like, wrong part of the supply chain. And really part of what we're trying to do with a lot of this is look for durability, and having a hardware component, which is why we've also got into IoT, helps with that durability. But I saw a post this week that connected into some of the durability conversations we've been having on this podcast around pure play AI tools. And Ronan C., who's a communications advisor, he said the AI vibe coding hype is cracking. Lovable hit 100 million AR in June, but website traffic is now down 40%. Vercel's V0 visits has plummeted 64% since May. Security changes may explain some of it, but not all of it. Bolt, their traffic is down 27%. Replit has cooled as well. ARR looked explosive, but a lot of it came from month-to-month users, and they churn fast. Heavy users drove up inference costs. Startups raised prices, then growth slowed. The unit economics look fragile. And if we look at just this team here, we screwed around and played with Replit for a bit, but then couldn't get our head around some of the security issues to make our own tools right now, and we're busy doing other bits and pieces, so we churned off. But this is one of the fears that I've had in going into pure play AI SaaS type stuff, is that we don't know yet where the durability is going to come. And it's one of the reasons why we still focus so heavily here.
100%. Like we've talked about this before, and a lot of SaaS out of the US hitting 5 mil ARR pretty quickly, but it's a false product market fit because it's coming from a discretionary spend within enterprise. And even on a pitch call this morning, the founders were saying that in legal tech, and legal firms are reporting being saturated on new tech adoption. And so there's a bit of pushback there. Our own experience with this, I think it's fairly typical of the tech diffusion curve where you get the early adopters, you get the evangelists who are there for the cool tech, and then normally you have to bridge that valley of death to get the actual adopters where there's real value back to the business. I think a lot of these are never going to bridge that. And what we're seeing is much faster adoption to much bigger revenue numbers. So these false product market fit indicators, but then this drop off as they hit the valley of death. And I think we'll continue to see more of this. And this is why we focus so heavily on durability.
Yeah, I agree. I think the difference here is like Lovable was founded in I think it was like, I just searched up, it was September 2023. And they've already gone past 100 million ARR USD. So I think like in this situation, even if it is false product market fit, they've still got the war chest to actually iterate and like keep working on the product to find something that's going to be sticky going forward.
Agreed, but the problem from where we sit is we've got to get venture returns for our LPs. And so I reckon even people who have falling traffic and whatever else, they probably can still build a great business. But if you got into the wrong time at the wrong vow, you're not getting a return. And so that's part of the problem. Like you can choose the right company in that it's a great company and you can lose your ass because the entry point, whatever else, fucked you.
I think this comes back as well for me, like the cohort analysis, like understanding the exact type of customer you're onboarding, like we say back in 23 for Lovable versus now, and really understand, deep diving on that ICP, like rather than just going for the land grab of revenue and ending up with customers that are a high churn risk. Like this kind of points to the month-to-month users that are a bit more discretionary in their spend. Like being really specific. And this is where I think countries like Australia, why I think we do build the better foundations of a business, because we have to go broad to start with, to then go narrow and niche to go into a bigger market, versus somewhere like the Silicon Valley mentality, which is grow at all costs, hit the growth metrics, even if the customers aren't exactly within the ICP, and then there's a churn risk. And Vu Tran talked about this, like how at Go One, they would essentially fire, like they would offboard customers who weren't using the platform, even though they were paying. And it can seem counterintuitive to a founder to be told, yes, you've got this customer that's paying and not using your product, leave them there, versus actually no, churn, force them away, because otherwise you can then lead to this blind spot churn in a moment of an economic cycle shift or whatever cause of discretionary spend no longer being needed or cost cutting, whatever. So I think there are some good lessons in here for founders.
I guess it's just trying to digest this little word called durability. And another little article related to durability is that OpenAI gets a $50,000 contract with the government, with the Australian government, which when I first read this, I went, why the hell are they wasting their time? But OpenAI know that once you get in, and I see founders making the mistake where they want to try and sell the really big thing, where actually the land and expand, which is what this article talks about, is often the most successful, where you just get a little thing in there. Now, the government has above $80,000, it has to go to tender. Below 80,000, it doesn't have to go to tender. So they were able just to get in with something very small. And what they've also done is that they've partnered with an advisory firm and also use lobbyists quite well. And I think you'll find as the years roll on, we're going to end up in the tens of millions, if not hundreds of millions. And I think it's a playbook that I think more B2B founders could use, where they get their expectations and their runway a little bit more stretched out and start with small, so then they can go and expand, especially when you're an unknown commodity. Whereas too often they're trying to go in too big to try and meet some arbitrary targets that they've promised someone, and they never get enough momentum to pull that off.
I think that point about contract value and avoiding a tender process or extra procurement scrutiny is such a good way for founders to make entry. And this is across all stages of government. So this applies with state, federal, even different councils, but even then understanding the individuals within those roles and what their financial authorization or delegation is without further sign off. It's a great way to get your foot in the door and then expand.
Yeah, we're also seeing that in enterprise as well. So our latest deal into Paperleaf, having really good success doing a land and expand. So selling one module to the private sector of the schools, and then expanding to 10 modules once they're in and embedded.
Yeah, they've done really well at that playbook. Well, let's shift gears out of the durability world. There's just a couple of people movements in our ecosystem that I thought we'd chat out. So Susanna George, there's an episode that I'll link that Susanna did with us in the very early stages of this podcast. I reckon it would have been first 10 episodes.
One of the first guests.
Yes.
Yeah.
She was kind enough to lend us her time to come in and have a chat. Really great chat. Susanna posted a couple of weeks ago that this week was a career-defining, heartfelt milestone. 14 years ago, I started Urban List from my bedroom with nothing more than a laptop, some Post-its, and a drive to create something that mattered, moving people out the door and into the moment, creating the culture they wish to see. This week, I handed the reins to Jackie Labrui as incoming CEO, an absolutely brilliant human with the grit, smarts, and heart to lead us to our next era. Huge moment, and it's hard to wipe the smile and pride off my face. She's a gun. From the moment that she joined, Jax has been an extraordinary leader, working side by side to define our strategy, help us grow into the business we are today. That post continues to go on, saying that she's not going to fully step back. She's not going to be involved in daily operations, but it's going to remain active, offering counsel to Jax and the exec team and staying close to transformative projects. But I think this is at least one of the goals for successful entrepreneurship, is you build something great enough that you don't have to be there all day.
I'm so stoked for her. That's super exciting that she's able to build it to this point and step aside for a new CEO to come in. So bloody well done, Susanna.
I like the playbook. So Jackie started a while ago and has worked. So there's been time to learn about each other, learn approaches, build that trust and respect. It is the hardest phase, though, when an entrepreneur wants to step back and let somebody else look after the baby. So there's going to be some inevitable interesting times where people will do things differently to what might have been done historically, and so that's the trick that needs to be navigated. But I think the worst thing, or the most difficult thing entrepreneurs can do is like too fast or too harshly bring in a GM or a CEO from outside too quickly, because at the end of the day, founders build companies that are a well-tailored suit to them, of who they like to work with, how they like to operate, how they like to do things. And to suddenly bring somebody in and try and squeeze them into your suit and not expect there to be problems is a problem. And so when you can do it in a manner where you sort of work together for a while and then you grow into the role, that certainly reduces the risks.
Another founder that's making a bit of movement is Mark Orchard, with the announcement of the sale of Planet Startup this last week, which I'm so stoked for Mark.
Is there a nicer person in the ecosystem than Mark?
He just deserves every success, like a genuine, down-to-earth human that loves people and wants to support them and gives so much. So it's a fantastic outcome. It's great to see for him and Reese this outcome. But the announcement was, it was officially announced last week that Planet Startup has been acquired by Scalar Partners. They've been going, so Planet Startup.
I was explained the other day that it's actually Scalare.
Scalare. Okay.
All the prior episodes, I was calling it Scalar, I think.
Oh, yeah.
Scalare.
So I'll go again. Yeah, so it was officially announced last week that Planet Startup has been acquired by Scalare Partners, which is an awesome outcome after only 2 years. But in that time, the boys have built a 60 client plus business, millions in capital raised for that client base, and over $150 million worth of client exits. So they've definitely been busy in that time. And I'm excited for Mark to see where he goes next. Like, obviously, there'll be some sort of retention requirement here, but always keen to see what Mark builds out.
Yeah, I absolutely love Mark. As we discussed before, we've got some questions around Scalare. There's just so many different tentacles, and the way it previously held itself out as a good way to access venture capital exposure, which I think it's the worst way to do it, given the operational risk that this thing has and and the opaqueness. I had a whole lot of stuff. I don't know if I can be bothered going into it, but any help in the ecosystem is going to be good help. But it does highlight at least the value of script sometimes, because the share price has fallen 62% since late last year. And looking at the docs, the current share price at time of issue was like 8.9 cents, but they've issued to the Planet Startup lads at 14 cents, which is I think the announcement was a 57% premium. That's one of the benefits of having some script. The average volume per day, though, I think is something like, I think it works out as the average volume is 85,000 shares. So what's that, about $8,000 a day on average? So it's a very illiquid stock, and Mark and Reese tied up, I think, they're in escrow. So it's one of those challenges. Their starting point is at a 57% discount, and if you wanted to sell, you'd drive the share price down even further. So they're obviously thinking that the Scalare model has a lot of upside for them in the future. Otherwise, I guess you wouldn't contemplate a transaction like that. And like even at TIFF, I hadn't seen Mark for a while, and he, I'm what, 4'2", and he's 8'7". He towers over me, but just with a big grin and with a genuine good to see you, how you've been doing. You couldn't find a nicer person. But at least they got a sale. And one of the things that I'm seeing more and more, and there was a post by Jason Lemkin, he caught up with a founder the other day that had an M&A offer in 22 that would have made him 130 million. Today they can't raise. So they're a bit stuck. And it is one of the things I'm seeing with some founders who believe they can still raise. And I don't want to be a negative Nelly and too much of a prick, but they don't have the dynamics to raise, let alone exit in this environment. And so the challenge is they've really got to be making decisions in that light, but some of them are spending and behaving like it's going to be a solvable thing. And with the AI world and what deals are available to investors now and how competitive it is, I do fear that there's some entrepreneurs in 26 that are about to get their hearts broken.
Yeah, I'm always reminded of that little phrase, you have to capture the opportunity of a lifetime in the lifetime of the opportunity. And I think exits being aware of the exit valves in this part of the cycle that you're at. And it's so hard to see the cycle when you're in the cycle. But I remember there was one of the 20 VC podcasts talk about this, is as a particular investor and how they help give that clarity on where they are in the cycle to their portfolio companies. So when there is an acquisition offer, they have that lens, because often I found like this back in 22, and again, depending where in 22, if it was early, like that part of the cycle, an offer like that sounds like this founder expected to continue building at the same rate of that cycle, expected more, and it didn't eventuate. So timing, there's nothing like bloody time to give you the clarity of hindsight, but just be aware of where you are in that cycle.
Jack, Ash?
Yeah, I think it's just so hard to time. I always go back to Simon Beard's comment, like the best time to sell is when you don't want to sell. And it's just such a good reminder.
Hell yeah, that's a good one.
But some businesses can still raise a lot and do a fair bit of damage. Aaron, you added something in about South by Southwest, which I'm interested to hear that Ash is going. So yes. I think we're about to...
yeah, let's see the reception. Ash gets next week.
I've already read the post. No, I am going. I will be there Wednesday, Thursday, Friday. I am part of a panel talking about the future of the workforce and thinking about how AI is a part of that and the ecosystem that needs to evolve around it. So I'm excited to be there. I will always take an excuse to go to Sydney, meet new people, even just on the earlier pitch call. So I think it's a good opportunity, but I resonate with part of the post, so I will hand it back to you, Aaron.
Yeah, so Jesse Wu wrote this post last week, and it kicked off with, "Few things make my blood boil as much as South by Southwest Sydney." And then she unpacks why.
Can I just pause you right there, though, Aaron? If you notice, her profile picture on LinkedIn is from the first South by Southwest. Sydney one as well, which just like, as I'm reading it, I was like,
The irony.
yeah.
She does actually call that fact out as well.
Yeah.
But what she does, she outlines in the post the amount of funding that South by Southwest has received from the City of Sydney, from different governments chipping in, from corporate sponsors, in order to attract the big brand to open their conference here in Australia. And it's the first location outside of Austin to actually run South by Southwest. But then she talks about the challenge of running satellite events and questions whether this is actually good for the community. And it just really resonated for me. I think for me, this is another example where the government is essentially consuming someone else's IP, someone else's business from overseas to come into our market, and it actually ends up fracturing our ecosystem. If that's, I would argue that same amount of funding was given to local operators to go and create a local event in with our local DNA, with the opportunity to hopefully maybe one day export that to other markets, that would have been a much better investment.
Well, and one of the big issues that she points out is we've given them 12 million, and then charge 1,500.
The ticket prices are insane
for massive ticket prices. So then the people that can afford it least but need the networks and the content most can't afford to come. And so the government puts these bloody walls around it. And meanwhile, the good events that we could be supporting get left behind. But
100%. And so I think this is where the role of government often ends up really misguided. And we end up bringing operators into a market that end up competing with the local ecosystem. And I guarantee as soon as that funding runs out, they will lift up and extract out and helicopter into some other jurisdiction that gives them funding. So it's not in our long-term interest.
I did like that she went on to say that she's starting an affiliated event called Rent Seeking Leech Week, which is just so happens to be over the same time of South by Southwest.
And there are hundreds of people subscribed to the event. So Sydney just beat Adelaide for this event in the initial tender to go out to bring it to Australia. I do wonder, as my feedback on the first year, so I went the first year of South by Southwest, I didn't go last year, and I'm going this year, was that the reason you generally go to these conferences is for those collision opportunities. And because it is at ICC, and then they have these satellite events, but the satellite events are so broad, you don't have collision time. I do think that South Australia does do festivals and conferences at another level. We are the festival state. It's there for a reason, right? As a tagline.
I think they're called shows rather than festivals.
Okay.
Was that a reference to the show that Jack attended?
Yeah.
Sorry, Ash, keep going.
No, I do wonder if it was here, would it be different? Obviously, I am biased to South Australia being able to pull these things off well. But I think the ticket fee is a big thing. I do think that this isn't something that is just a South by Southwest issue, though. The price of any conference these days is around that. Even South Star is expensive.
But they didn't have $12 million of government money. I think that's the bit that gives you the shits. Like, imagine what the ticket pricing of South Start, which is fucking awesome. Imagine what that could be with just $2 million of funding.
Yeah, I mean, they do get funding. I'm not going to disclose what the figures are, but yeah, I think it's great to get press and to get everyone together. And as I said, I'm using it as a reason to go to Sydney and force those collisions myself. But I have to plan it in the diary. I have to reach out and go, hey, I'm going to this. Are you going to anything? What are you going to? Where is it? Because the location is so sporadic and it's so big.
So rough back of the envelope maths. If they'd spent that 12 million and paid for the airfares for 4,000 people to go to Austin for South by Southwest, like that would have almost been the entire ecosystem. Like if you uproot 4,000 people to go, imagine the international connections that would build out off that. Imagine the press. Imagine the like from a capital efficiency point of view. I think the best thing, the best example locally of getting this right was Queensland government funding Myriad. It was a Queensland built event, and then partnering with Qantas and thankfully Mark Selby actually underwrote the Qantas cost to get a jumbo jet to fly a whole heap of people from Silicon Valley to Australia for the event. And the press coverage that got, the fact that for 2 years afterwards, I'd walk through the US and people would talk about Brisbane for the first time ever. But the networks that came out of that still exist.
Yeah.
And it was a fraction of the cost. I think we've got to stop this mentality of buying from interstate or buying from overseas and actually investing in building and supporting those that are doing it so we have a more robust ecosystem.
I will say that feedback on South by Southwest just broadly in the US is a declining return on investment as well. But I think it was a great controversial post that more people should be doing. Like this is the kind of thought leadership per se, I think that opens these conversations. And I think it's a great conversation to have. And I bet every post-event drinks I go to or lunch or coffee, this will be talked about. And so I even think that bringing this top of mind and having that conversation will hopefully get the right attention for it to be a little bit more thoughtful and maybe to actually bring in the right people in the ecosystem to be a part of the decision-making process might have been useful.
Yeah, that's a good point. And my only worry on that, Ash, is because the public servants are so risk averse. Like I remember doing a stint on contract in the Queensland government for the formation of Advanced Queensland, and their number one litmus test was, will this be a front page Courier Mail newspaper moment? And I think my only worry is things like this can make them more risk averse. So I hope they genuinely hear this feedback and that they do actually, to your point, bring in people to influence these decisions that are actually from grassroots in the ecosystem.
Agreed. Well, let's jump into some themes of the week.
Don drinking from a toilet.
Good
and
theme.
biting his t-shirt.
There's so much I could say.
I sometimes forget where I am.
That was just an announcement generally.
I was like, is that his professional voice? I'm not sure. Jack, I think the most important theme of the week is the update on the Bucks show.
It was good fun. Monday I was pretty useless because it's Sunday because of the public holidays. A lot of the...
We didn't see an outfit.
Yeah, what skirt did you go with?
Went one on the right, which is the long one, and cut it to knee length.
Uh-huh.
I didn't go full traditional. I did wear jocks. It's quite cold on Sunday. So, but a few of the Scots there with the proper outfit, they did it properly.
Right, that's all we get. That's
good.
Exciting.
Well, is there a theme out of that, Jack, that you would be willing to share?
No, I don't think so.
Is there a theme from the business you'd like to share?
This week really has just been catching up on the admin stuff. So we had a few deals that were just behind. So I had to catch up on that.
I've got a theme of the week for you, Jack, to share. It goes back to a convo we had a couple of weeks back. The work you're doing in the M&A space and your insight into regional markets. I reckon there's a theme there.
Yeah, I suppose in the M&A stuff, it was just the eye-opener for me was there's so many unsophisticated business owners that are just absolutely cleaning up. And it sort of goes back to what I was saying last week about the NDIS, like choose your market wisely. And the reason these guys are blowing out top line and profit is because there's no other competitors. Like they're a regional business, they've been in the game there. And when they're going for tenders, like they're beating the national providers because they're local, like all these other things, they're getting the extra points. So they're winning the contracts. And it's just such an eye-opener because I can compare like some Aussies that are in a pure play SaaS business going up against some absolute weapons out of Silicon Valley as their main competitor versus being in a regional business where you're the only operator locally and you're winning all the contracts. Like it's just such a different game.
Yeah, I like that. Well, my theme of the week, I've dubbed it like the delusion delta, but there's this thing when you're talking to founders. So I was chatting to a founder yesterday around investment readiness, and they kept referencing that they've validated the product, they've validated demand, they've got good traction and all these things. They've de-risked it. But then in asking questions and going deeper, they had no revenue, they had no contracts signed, no pilots underway. They purely just had some conversations. And I think this becomes a huge red flag, whereas they're trying to project this confidence, they're trying to project this certainty to the investor, but it comes across as completely naive. And so I think this delta between how a founder perceives reality versus I get the reality distortion field. But where conviction comes from me chatting to founders is when they call a spade, they see reality as it is, but then they build your conviction that despite the reality, they are going to achieve X, Y, Z. But they have the awareness of fact, and they come from that as a base on which they've built their thesis of how they're going to build forward, versus just the complete reality distortion of just no basis in reality. So yeah, it's really telling, and I see it more in first-time founders, like this need to kind of present like this optimism, but it's a blind optimism where they're just discrediting things that they might see as a weakness that they think an investor doesn't want to hear. Whereas own the weaknesses. We can see the weakness, own it, but then extrapolate out, build conviction on how you're going to execute.
But it's a hard one, right? Like, it's sort of that irrational exuberance. What's the right level of insanity? And
like drinking out of a toilet.
But if it's based, if they still see reality as it is, but they're distorting where they can take it, I think that's the little nuance for me. But when they start saying the sky is red and it's clearly blue, that's where I can't build conviction.
Yeah, and I must admit that as we get further in this journey and our own time has become more precious, sometimes you've actually got to cut a call short. I've had to do it a couple of times recently, going, look, I can't help at the moment. Here's the things I'd get you to go and have a look at, and then let's touch base.
Yeah, and the other thing I've been having to do is put a hurdle in before even the meeting, just like asking, can you demonstrate these key things? Because that very early stage founder support, like I want to help founders, but it's a huge time cost.
Well, my theme of the week, which is partly related to me, partly related to some in the portfolio, and partly just related to entrepreneurship in general, is this constant cycle of waiting until there's a burning platform until you actually do something about it. And a bit like what I was talking to you about before, where there are some founders who I think are going to get their hearts broken next year that can't raise. They're not actually making the hard decisions now. They're not actually dealing with the reality of now. And because the entrepreneurial mind has a time concept problem, like it thinks it can build Rome in a month, and then actually what takes a month probably takes more like 8 months. And so they leave it until like the week prior and then wonder why everything falls apart. Like, hope is not a risk management strategy. And I sometimes have to remind myself of that. But I think, yeah, the theme of having plan A, plan B, but the moment something happens that could actually cause you any form of pain, taking action there and then to get started. And I've just seen it so many times recently. And especially as coming to the end of the year, like, Australia is a weird place. If a deal has started before Melbourne Cup, you probably can complete in December. If you start raising in the last weeks of November, like, goodbye till Feb. And then you get into a situation where things become urgent, and then you're going to end up having to accept terms that you wouldn't want to, and it could all have been avoided. So I would just get people to reflect on what are the things, which then flows nicely. We haven't had Philosophy Corner in a while, which I know upsets Ash and causes her great concern. So I thought I'd play this one because it's simple, it's not complex, and it's not all that bright, but I've used it a couple of times recently, and I think it is just a good reminder that when you've got hard decisions to make, this could help.
This is one of the best questions, I think, to ask yourself when faced with a decision, which is, what would you tomorrow want you today to do? And this is something I've relied on for years to help me get perspective and make better choices. And the reason it's so effective, I think, is it rips you out of the present moment. It stops you from relying so heavily on the confused chemical signals coming from your body. Instead, it gives you a bit more distance. It depersonalizes the decision, helps you treat yourself like a friend you're responsible for helping. In Peterson language, it forces you to optimize for long-term thinking instead of immediate gratification. And it reminds you that ultimately, decisions are not being made for you now. They're being made for you in 24 hours and 24 days and 24 months. You can see our decisions are investments that we make into our future.
So I quite like that. And with some decisions at home and a few other bits and pieces where you sort of get caught up in that moment and there's multiple different options and some are harder than others and more conflict. I've just found some helpfulness going, well, hang on, a week from now or a month from now or 10 years from now, what would I look back on and either give myself a pat on the shoulder or a slap in the face? Drinking from the toilet, maybe one of those. We'll soon find out.
No, that is really helpful. Maren and I did a couples session 2 weekends ago, and a lot of that resonates with, particularly around kids and parenting, and I can see some of the decisions I'm making there. Separation of self from the moment is a good lens. Ash, did we hear your theme of the week?
Okay. I thought I was going to skip out on that.
No, I was reprimanding her for not supporting me drinking out of the toilet.
We can move on. That's fine. I was going to talk about USP, so maybe that's your USP, Dom. Not sure, but I had a lot of conversations relating to founders, but also businesses communicating what their unique selling prop to the market is. And I quite often, when we're on a call with founders, dangle, oh, well, what about this, 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 and this? And have you thought of this? And it's really the founders who can pull it back and go, yeah, we're aware, but X, Y, and Z is currently target. We think that this is Y, da, 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 da. Like, I think it's something that the more I'm working with all of you, the more it becomes clear of how important that is for the founder or founders to really have and to be 100% convicted on it. It's not a no to those other opportunities, but it's we're aware. We've got our eyes open and our ears open for customer feedback or market pull. But no, here is where we are today, and here's the focus. And I think that's something that, it's just become more and more evident in the world of AI, where opportunities seem to be everywhere in founders' minds. And, as John just mentioned, founders think they can do something in a week that's actually 8 months if you do it properly and make it scalable. I think in the world of AI, people's time awareness is evaporating even more so, and I know I'm a victim of that.
Yeah. All right.
Very true.
Yeah, absolutely true. Well, we'll jump into some charts.
I do have a hard stop, so you're going to have to move quickly.
I like how that only came out with mention of the sharks.
Yeah. I mean, it's just a coincidence.
Here is a chart that shows the increase just over the last 10 years. The S&P 500 per share sales has increased 80%. The dividends have increased 85%. But the earnings per share is up 156%, and the index is up 248%. And so, yes, we've had sales, dividends, and earnings increase, but actually the biggest contributor is the multiple expanding. But if we do enter a period of time where the market starts to pull back, during periods of time where the volatility index explodes, is often the time where there's peak negativity. But this is a chart that actually plots market lows with volatility. And you'll just note the best time, and this is intellectually true, everyone knows this, but during difficult times, you need something to help you get out of the fear. If you have a look at market lows and you look at the spikes in vol, you should be buying every spike in vol. Every time that vol spikes, that often is the beginning of a new period up. But it can be difficult. I remember having lunch with Dad in the 2008 financial crisis, and we were having lunch at a time where if the market kept falling at the same rate that had fallen over the last 2 weeks, we'd be at zero in like 16 days. And I just remember that time and the craziness, and that was the time we should have been going hard. This is a chart of the SpaceX launches split by booster status. So blue is reusable booster and yellow is a new booster. And you can just see the exponential growth of reusable boosters, which is just going to change what happens in space. I didn't get a chance to put it in this week, but Bezos makes the point of why he's really investing in space is because that's where he's going to put data centers, which sort of makes sense. You just throw it into space. You get 24 hours a day of sun. So you get renewable power 24 hours a day. And then with the other satellites, you beam the connection back. I think that absolutely makes sense.
I have to jump.
Thank you, Ash. I'll send you some more videos. See ya.
See ya.
We spoke about gold and silver last week, continuing to be on an absolute tear, which I don't think is a good thing. But Bitcoin has been on a tear, and the relative strength index is a technical indicator that looks at a range of things and the strength of an asset. And we still aren't near where the relative strength has been for Bitcoin in its previous peaks. We're sort of around 80 or 75, 80. In prior peaks, Bitcoin has always peaked over 90. And so if this cycle continues to play out, we've still got quite a bit to run. I personally think I think there's so much money and so much stuff flopping around in the ecosystem. I think 2026 is going to continue to be a big year, although it could become more volatile. And that is the charts. Wasn't so bad.
No, they were good.
There is one more Philosophy Corner video that I'll end the show with now that Ash is gone. But before I get there, what are we looking forward to?
Looking forward to heading to the Gold Coast for our friend's screening of his documentary and catching up with some of the crew down there. That's going to be fun.
We'll be able to give...
sorry.
Well, we'll be able to give Mikey an update, Jack. He's always interested in what you do on the weekends.
Oh, yeah. I'm surprised I haven't got a message from Mikey after last week.
It's his 10-year wedding anniversary today.
Oh.
Anniversary, Mikey and Hales.
Where he's at now? What a goal. Got the exit.
Yeah.
Your wife still likes you, I assume. Kids are at that age where you get to play with them and go on holidays.
Yep. Yeah.
I'm looking forward to going to Early Beach tomorrow. So going up there for a week with the family. So should be good. Hot weather.
Early Beach?
It'll be nice up there.
Where are you staying?
Don't even know, to be honest. Anna has sorted it.
Caravan park down there, Mission?
Nah, I've done the caravan park last time, went to Early, but this time we're in an apartment. Different.
That Early Beach McDonald's, Jack, is the only McDonald's I've ever been asked to leave.
What did you do?
For some reason, I was standing on a table reading the Courier Mail, like shouting the Courier Mail to people after a particularly big night. This was a good 20 years ago.
I still, every day, Don, I learn something new about you.
Yeah. Well, I've got Matilda's 6th birthday. I cannot believe I am the father of a 6-year-old on the weekend. And it's a joint birthday with one of her school friends hosted at our place. So we have 28 of the class coming, plus parents, plus hangers on, plus everything else. And when I asked Matilda last night, are you looking forward? She's like, oh, at home's going to be boring. I wish it was at Mini Bounce. It's like, God. That'll be all right. I've got my smoke machine ready, got the air track ready, trampoline.
That'd be good. 6 is a good age.
A hose.
That'll be fun.
I think it'll be fine.
Yeah. Very cool.
All right, T. Well, Aaron, I'll see you tonight. Jack, I'll catch you on the Flippy Dippy. You can hang on because I just want to go through that Val doc.
Yeah,
Sounds good.
All right, guys. See ya.
Thanks, guys.
See you.